financial, how to account for the financial instrument in our books. Yesterday, we started on the classification and measurement. Therefore, when you enter into contract in this financial instrument, there is what we call initial recognition, initial measurement. When you enter, for example, you are giving me 12 million, for example. How will I recognize that 12 million in my books? We call it initial recognition. Then on subsequent measurement means going forward, how do I recognize that item? And we say that classification of financial instrument will be informed by two things. Number one, we said that it will be informed by the business model, the entity's business model for managing this financial asset. Number two, we said that it will be informed by the cash flow characteristics, contractual cash flow characteristics. Now, based on those two items, we say that financial assets will be categorized into three. Number one category or classification is financial assets at fair value through profit and loss. And we say that these are short-term instruments used for trading purpose. And short-term, therefore, we report them as current assets. Any gain that comes in this, we report it as profit in the P&L. Then we also say that we have financial assets at fair value through OCI. OCI means other comprehensive income. Therefore, it means that I'm going to invest in stock exchange or on the market, but my intention is for long-term. Therefore, when I purchase this instrument, it means that I'm going to recognize it in my financial statement as a non-current asset. Then we say that this non-current asset, if it gains value or it reduces in value, that difference in fair value in measurement, I'm going to recognize it as OCI, other comprehensive income. Then we also say we have financial assets at amortized cost. Now, amortized cost will fall under the cash flow characteristics, contractual cash flow characteristics, where we are going to measure, where the contractual cash flow characteristics is that we are going to on specified debts, to receive some interest and also maybe some principal or interest alone. Then at the end of the maturity period, I'm going to sell this instrument. Then we say that financial liabilities are only measured into two classifications. That is fair value through profit and loss and amortized cost. Those are the two classifications of financial liabilities. Then we came to something very important called the transaction cost. And we say that if it is a financial asset measured at fair value through profit and loss, which is short-term, any transaction cost you are going to write off through P&L. You write it off through P&L. But if it is financial asset at fair value through OCI, then any transaction cost is added to the instrument. But if it is financial liability, any transaction cost you are going to subtract from the instrument. That is what we discussed yesterday. And today, I want us to look at a very simple example to see when we say financial liability, financial asset, transaction cost, you write it off through P&L. What do we exactly mean? What do we exactly mean? Because yesterday we did at amortized cost, financial liability at amortized cost. Therefore, let me just give you an example and show you how when we say you are going to write it off through P&L, what does it mean? What does it mean? Therefore, we continue to say XYZ Limited. You say XYZ Limited bought 10,000 shares. 10,000 shares in a listed entity. In a listed entity at Kenya shillings 5 per share. At Kenya shillings 5 per share. At Kenya shillings 5 shillings per share. And a commission of Kenya shillings 0.25 was paid was paid to the broker, was paid to the broker. A commission of 0.25 shillings was paid to the broker. The fair value of each share at that 1st December, the fair value of each share as at 31st December was Kenya shillings 3.5 per share, 3.5 per share, 3.5 per share. Required. Show how XYZ Limited will account for the above. Required. Show how XYZ Limited will account for the above. Show how XYZ Limited will account for the above. Now, what we are saying here, we invested in a financial instrument. Let's say this is at fair value through profit and loss, at fair value through P&L. This is at fair value through profit and loss. Let's say it's a short-term investment. Therefore, on initial cognition solution, the fair value equals to 10,000 shares times 5, which is 50,000. That is the initial investment. Therefore, on this initial investment, I'm going to debit financial asset, so 50,000. I credit bank or cash 50,000. That is what I have invested. Therefore, I'm going to debit financial asset. Then the commission, which equals to 0.25 times 10,000 equals to 2,500. How do I account for that? I'm going to debit P&L 2,500. I charge it to P&L. I credit cash with 2,500. Therefore, that is how I'm going to account for the transaction cost. I'm going to debit my P&L. Now, on that 1st December, now the fair value of this instrument will be equals to 10,000 times 3.5. If the share has reduced in value, it's now 3.5. It's now 3.5. Therefore, I'm recognizing 35. I'm recognizing 35 there as the fair value at the end of the year. Therefore, we have a loss. But how much is the loss? 50,000 minus 35, which is 15. The loss of 15,000. Now, that loss of 15,000, I'm also taking it to P&L as an expense. I'm taking it to P&L as expense. Just a minute. Sorry for the, but we shall overcome. Okay, what I was saying, at the end of the year, our financial instrument has now come to a loss of 15,000. Therefore, with that loss, I'm going to debit P and L with 15,000. I credit financial asset. With 15,000. I credit financial asset with 15,000. At the end of the year, that is what I'm going to do. I debit P and L. I credit financial asset with 15,000. Therefore, that is how we are saying that if it is a fair value through profit and loss, any transaction cost, you are going to take it to P and L, any transaction cost. Let's look at another example where we have OCI, and see as we move on. This is where it's P and L. Let's look at another example where there is OCI. We say X Limited acquired, another example, X Limited acquired 200,000 shares. X Limited acquired 200,000 shares for Kenya shillings 500,000. X Limited acquired 200,000 shares for Kenya shillings 500,000. Ingaring issue cost of 40,000. Ingaring issue cost of 40,000. This was part of its long-term strategy. To realize the gain in future. This was part of its long-term strategy to realize the gain in future. The fair value of the shares was Kenya shillings 620. The fair value of the shares was Kenya shillings 620 as at 31st December. The fair value of the shares was Kenya shillings 620,000. Kenya shillings 620,000 as at that first December. The shares were subsequently sold for Kenya shillings 650,000. The shares were subsequently sold for Kenya shillings 650,000 on that first March. The shares were subsequently sold for Kenya shillings 650,000 on that first March. Required. Show how X will account for. Show how X will account for the above. Show how X will account for the above. Show how X Limited will account for the above. Now, this is investment, but we want to realize is a strategy, long-term strategy to realize the gains in future. Long-term strategy. Therefore, if it's a long-term strategy, then we are going to hold this asset at fair value through OCI because it's a long-term strategy. Therefore, I'm going to hold this asset at fair value through OCI, Therefore, solution, let's say solution. Solution there. Initial recognition, I'm going to debit financial asset with 500K. 500K, that is was my initial investment, 500K. I credit back with 500K. That is on the initial recognition. Then there is also issue cost. Issue cost. There is also issue cost. Issue cost here will be I debit financial asset with 40K, issue cost was 40K. I credit cash or bank 40K, like that. I credit cash or bank with 40K. Therefore, my total fair value equals to 500 plus 40, which is 540. For the initial recognition, my total fair value of this instrument is not 500 like in the previous one, but it will be 540. The issue cost we add to the instrument. Then on that 1st December, fair value equals to 620K. On that 1st December, the fair value is 620K. Therefore, there is a gain. There is a gain which equals to 620 minus 540, which equals to 80K. There is a gain of 80K on 31st December, on that 1st December. Therefore, this gain is recognized through OCI. Therefore, with the gain, I'm going to debit financial asset with 80K. I credit OCI. OCI is other comprehensive incomes with 80K. I credit OCI. I credit OCI there. I credit OCI. Now, on that first, now we have recognized the gain, but now we are not going to take it to P&L that gain. It will go to OCI. OCI. On that first March, now in the next year, we are going to sell. Selling price equals to 650. We are going to sell our instrument. To do away with this instrument, we are going to sell it. How much are we going to sell it? We are going to sell it at 650. We are going to sell it at 650. Now, on sale of this instrument, how much is the profit on that 1st March? The profit is 650 minus 620, because on that 1st December, the value was 650. But on that 1st March, after 3 months, the value is 650 when we are going to sell it. Therefore, we have a profit of 30. We have a profit of 30K. Now, this is the profit. With the profit, that is profit because we are selling, it's not OCI again. That is the profit. We are going to debit. We debit financial asset with 30K. Then I credit profit P&L. I credit P&L. It's a profit 30K. Profit 30K there. Profit with 30K. I credit P&L with 30K. Now, remember, now I have sold the instrument. Listen very carefully. I have sold the instrument, therefore I am going to de-recognize this instrument. I remove it in my financial statement because I'm de-recognized. I'm selling it. I'm selling it at 650. Therefore, on sale of this instrument, I debit bank or cash 650. I credit financial asset because I'm selling with 650. I'm recognizing, therefore I debit bank, I'm receiving money, I credit my financial asset. Now on the recognition, write this, on the recognition, the recognition, you should, on the recognition of the instrument, on the recognition of the instrument, reclassify the gain recognized in OCI to P and L. On the recognition of the instrument, reclassify the gain recognized in OCI to P and L. Which is the gain we recognize in OCI? Remember, in our statement of changes in equity, OCI, we had reported 80 gain. We had reported 80 gain, 80,000 as a gain. But now we are selling off the instrument. When we sell off the instrument, now we are going to remove this from OCI. It's now not a comprehensive income. It becomes a profit for us to eat. It becomes a profit. Therefore, I'm going to reclassify it to P and L. 80K comes to be a profit or a loss, profit or loss. That is how you are required to recognize this instrument up to when we are selling it on that first March. Up to when I put the category of selling because I wanted to show you that whenever I'm doing away with the instrument and there is any gain I recognize in OCI, you are required to do what we call the classification. You remove it from OCI, you take it to profit, because now it means you realize the profit there. But if the instrument is there forever, then that will be recognized as OCI until you sell the instrument. That is how you account for that. Now let's go to what we call hedging of financial instruments. Hedging. I believe that one is okay. If you don't have any other question, let's go to hedging. Hedging. Let's go to what we call hedging. And remember to read our notes. When you go to our notes, you will find something good to read. Very brief notes, just to guide you. Very brief notes. It doesn't need anything. Very brief. Let's look at hedging. Now, when we talk of hedging, this is trying to reduce the risk on any investment. The risk on any investment. Like, for example, you want to venture into business that you have never done. This business may end up disappointing you. Therefore, what you do, you put a kampango account somewhere so that if you are disappointed with the business you want to venture in, then you will be okay. Let me give you an example of hedging. For example, I want to invest internationally. I want to go to invest in Uganda. Uganda is my good neighbor. Therefore, I want to go to invest in Uganda. Uganda is my good neighbor. Therefore, what do I want? I want to go to invest in Uganda. Therefore, when I go to Uganda, maybe I have Kenya shillings 1 million. This Kenya shillings 1 million, I take it to Uganda. When I go to Uganda, I find that the exchange rate is shillings 30. Therefore, it means that I will have Uganda shillings 30,000 or 30 million Uganda shillings when I go to invest there. That is on 1st January. I want to invest Kenya shillings 1 million in Uganda. Therefore, of course, I will not take Kenya shillings to Uganda. I will translate to Uganda shillings. How much is the exchange rate? The exchange rate is 30. Now, when I go to Uganda, let me say I want now at the end of the year on that 1st December, I want to prepare my financial statement. If I want to prepare my financial statement, it will mean that again, I translate this Uganda shillings into Kenya shillings. I will translate this 30 into Kenya shillings. Therefore, to come to translate, maybe at the point of translation, now the rate has gone to 40. Exchange rate has gone to 40. Exchange rate has gone to 40 from from 30. It's now 40, extending at 40. Therefore, if I want to translate 30,000 into Kenya shillings, 30,000 into Kenya shillings, how much is that? Can you quickly? I don't have the calculator today. Mwalimu hana calculator. Can you quickly? 30,000 divided by 40. 30,000 divided by 40. Mwalimu hana calculator. 750. Thank you very much, Waziri. I'm only getting 750. Now, when I went to invest on 1st January, I took 1 million. Out of the 1 million, it was 30,000 in Uganda shillings. This money is still 30,000 in Uganda shillings, but now I want to prepare my financial statement in Kenya shillings. I translate again. When I translate, you find that I'm only receiving 750 from Uganda. I'm only receiving 750. Therefore, I have made a loss on that investment. I have made a very big loss. Therefore, what you do, if you want to invest internationally, we do what we call forward contracts and futures contract. Therefore, I will go and fix this rate at 25. I fix with the bank. For example, we agree with the bank that come December, I will translate my money at the rate of 25. We agree on January. Therefore, come December, when I want to translate my money, I will not translate at the prevailing rate, but I already fixed at 25 with the bank. I already fixed at 25 with the bank. Therefore, I will go to the bank, they send me that money at 25, which means I'm getting like, let me say like 1,200. I'm getting like 1,200 there. I'm getting like 1,200. I'm getting like 1,200. Therefore, on my investment, I'm not incurring any loss because of the exchange rate. Because of the exchange rate, I'm not incurring any loss. Therefore, that is what we call hedging, trying to mitigate the risk, to reduce the risk on your investment. Therefore, for accounting purpose, hedging means designating one instrument so that its change in fair value is an offset in the changes in the fair value of a hedged item. Designating one or two items so that its change in fair value is an offset in the change in the fair value of a designated hedged item. Now, I now believe you understand what hedging is, trying to reduce the risk. I have shown you an example, trying to reduce the risk. Now, there are three types of hedge. There are three types of hedge. There are three types of hedge. Types of hedging. We have number one, we have what we call fair value hedge. Number two, we have what we call cash flow hedge. Then number three, we have what we call hedge of net investment in foreign operation. Hedge of net investment in foreign operation. Wasiri, you say you have a question. Unmute. Let me unmute you and see and hear what you have. Wasiri, I hear what you have.
Thank you. I just wanted to ask something. You said, for instance, if you have, let's say, there are 1,000 Kenyan shilling, and then the rate was 30, that's why we got 30,000. And then you discussed the issue of fixing the rate with the bank. I understood 25. But then I was thinking, if you are fixing the rate at 25, then it means you take the 1,000 times 25, which is 25,000. And maybe if you're translating back to Kenyan money, it remains 1,000. My question is, how comes you fix the rate at 25, but then use the 30,000 divide by 25 to get 1,200? Was it for purpose of illustration? How was it? That's my question, please.
Oh, now we said that the moment I was investing, it was 1 million. Then I extend to Uganda shillings. I multiply by 30. I have 30,000 Uganda shillings there. 30,000 Uganda shillings. Now, I'm assuming that I have not done anything on my business. I have not done any business. My money is just in Uganda shillings. Although it has been trending, but I don't want to complicate things. There is a profit, there is anything. Now we have this one. Then what I was saying, Waziri, is that I got to fix. At this time, I agree with the bank that on come December, for me, I will do at 25. Then when it comes at December, when it comes in December, I will use the rate that we agreed with the bank. Nothing else. If, for example, if the exchange rate has come to 20, it has come to 20. For me, I will not come to 20. I fixed at 25 with the bank. Therefore, anything else that is coming on top, that is the interest of the bank. That is the interest of the bank. Or, for example, maybe I fixed at 30. I just still fixed at 30. Therefore, come December, I will still translate at 30. Therefore, when we talk of hedging, we are just trying to reduce that risk so that I will not get any loss on my investment, on my initial investment. Therefore, if I told you very well, is that when you take 30,000, now I want to translate to Kenya shillings, I divide by 25, which means I'm getting 1,200. Therefore, here, I have not incurred any loss, but from my hedging instrument, in fact, I have received a profit. I have received a gain from my strategy. From my strategy of hedging, I have gotten a gain, a profit of extra 200. I'm going to show you how you account for 200 as we move on. I'm going to show you how we are going to account for the 200. Therefore, Waziri, you can now come up again with your question if it's not clear. You can unmute again.
No, I think now I have understood. You change at the rate and then you fix a rate for future transactions.
Yes.
I think that's clear.
Thank you.
Thank you,
Okay. Now let's move on now. We say that there are 3 types of hedge. We have fair value hedge, cash flow hedge, and hedge of net investment in foreign operation. Now, when we talk of fair value hedge, this is the hedge against the reduction in the loss in a fair value, a hedge of exposure to changes in the fair value of a designated asset, a hedge of exposure to changes in the fair value of a designated asset. Therefore, I want to reduce the fair value of my, the risk of changes in the fair value of my asset. Therefore, we call it fair value hedge. Then when we come to cash flow hedge, it is a hedge against exposure on of variability, exposure to variability in cash flows, variability in cash flows. For example, I'm investing in bonds, I'm investing in these liquid businesses. Therefore, I don't want to lose money in liquid form. Therefore, the cash flow, for example, I'm investing in loans, and for example, when I'm investing, the interest rate that are available is the fixed interest rates, for example, fixed interest rate. Therefore, if I want to hedge against this fixed, maybe, for example, I want to get more interest, to get more profit, maybe the fixed interest is maybe 20% fixed, 20% fixed. But it will come a time that if it will remain 20, I can incur loss on it. Therefore, I swap this fixed rate with the variable. You swap the fixed interest with the variable interest rate, for example. There is interest rate swapping so that you hedge against the exposure in the variability of the cash flows you are going to receive in the future. Therefore, maybe you hedge variable, you go and fix, or maybe you hedge fixed, you change it to variable. Therefore, you are just playing with the market so that you don't incur any loss based on the either changes in the interest rate in the market. Therefore, that is the fair value hedge against the changes in the fair value of the estimated asset. Cash flow is the variability in the cash flows. Then hedge of net investment in foreign operation is what we are saying. For example, you want to mitigate against the foreign exchange rates. Therefore, you do what we call also hedging there. Those are the major three types of hedge. Major three types of hedge. Now, let's go to the next item called conditions for hedge accounting. Conditions for hedge accounting. Conditions for hedge accounting. Now, when we say conditions for hedge accounting, it means that you cannot just wake up in the morning after you realize a loss on your investment and again on another investment, then you lie to the market that you had hedged. No, there is some conditions that when you want to do hedging, you must have documented that I'm doing hedging so that we know that whatever you are doing is trying to mitigate the risks in the market. Therefore, before a hedging relationship qualifies for a hedge accounting, the following conditions must be satisfied before the hedging relationship qualifies as a hedge. We have the condition that we must qualify before we say we have hedged. Number one, the hedging relationship must be designated as a hedge at the beginning of the year, or at the beginning, or at the inception, as a hedge from the inception or at the beginning, based on the entity's risk management objective and strategy. It must be designated as a hedge based on the entity's risk management objective and strategy. Therefore, you must document it from the beginning as a hedge. For example, when I go to interest rates, I must document that I fixed this rate because of hedging purpose. It's documented. Therefore, there will be no any other question that why are you reporting this? Because there is a way we are going to report hedging, profit from hedging and profit from just normal business. Therefore, for that separation, I must document that this was a hedge, so that at the end of the year, when I have the profit, I document it as a profit from the hedging instrument. Number two is that the hedge is expected to be highly effective. Therefore, my good friend Waziri, on a hedging instrument, you should not expect any loss, because it must be highly effective. Highly effective, like for example, when it is 30 exchange rate, I'm fixing it at 25. I know that very well that on 25, I'm not going to incur any loss. There will be no any loss. Therefore, it is highly effective. It must be highly effective. Then number three is that the effectiveness of the hedge must be measured reliably. How do I measure the effectiveness of the hedge? There are two methods that we are going to measure the effectiveness of the hedge. We have what we call the qualitative method and the quantitative method. But in the quantitative method, we measure it between 80% to 125%. The effectiveness of the hedge will be measured between 80% to 125%. Therefore, we need to measure it reliably. The effectiveness of the hedge, although we have what we call the qualitative measurement and the quantitative measurement. Qualitative measurement looks at the prospective, the future. We look at the future of our investment. Quantitative, we look at the retrospective behind, because we are going to use figures. I'm going to look at how the hedge has been effective during the reporting periods. We look at backward. Quantitative, because we are going to use this measure quantitative, I need to look backward. But if it is quantitative, it is prospective, it is forward-looking, forward-looking. Point number one, sir, to you, if you don't mind. No, those points, you have them in your notes. I believe you can just go there and go through them. I said the hedging relationship must be designated as a hedge based on the entities as a hedge from the beginning, based on the entity's risk management, objective, and strategy. But those points, you have them in the notes. Once you go to that handout, you will read all those notes, then you clarify maybe where you did not get it very well. Therefore, those notes are there in the handout. Then we go to condition number 4. Condition number 4 is that the hedge is assessed on an ongoing basis, and it must have been effective during the reporting periods. The hedge is assessed on an ongoing basis, and it must have been effective during the reporting periods. It must be assessed on an ongoing, therefore frequently. You assess it frequently, and it must have been effective during the reporting period. That's why I'm saying we use quantitative, we call it retrospective, going backward and see how has it been performing this hedge. Has it been effective or it has not been effective? Those are some of the conditions for before a hedging relationship comes to exist. Those are some of the conditions that must be findable. Now, we are required to understand also how we are going to account for the hedge in our books. How to account for the hedge in our books. How to account for the hedge in our books. We need to understand how are we going to account for the hedge in our books. Now, let's assume, for example, I have investment A. This is my investment A. Then I have investment B. I have investment A and investment B. Investment A is a hedged item. Then investment B is the hedging instrument. Hedging instrument and the hedged item. Now, when we talk of hedged item, when I talk of a hedged item, this is anything that is exposing the entity to risk. It can be an asset, it can be a liability, or any company commitment that is exposing the entity to risk. Like, for example, investment A. This is my original investment. It's exposing me to risk. Therefore, I need to mitigate that risk. Therefore, when we talk of a hedged item, it can be an asset, a liability, or any firm commitment that is exposing the entity to risk. We call it the hedged item. The hedging instrument is an instrument that is coming to offset the loss on a hedged item. The instrument that is coming to offset the loss on a hedged what? Item. We call it the hedging instrument. Therefore, on my hedged item, I have done investment. My investment here is a balance brought forward. Balance brought forward 500. Then at the end of the year, listen, balance carried down. Let me say it's 450. It has come to 450, therefore I have reported the loss of 50. The loss of 50. I have reported the loss of 50 there. Now, when I come to my investment B, balance brought down, still I put there 500. I just want to show you how to account for the hedging instrument, the hedging profit. I have 500,000. Balance carried down. Let me say it is 570. Therefore, there is a very big gain there. We have a gain of 70. Therefore, on our hedged item, I have made a loss of 50. On my hedging instrument, I have made a gain of 70. Therefore, the question is, how do we account for this in our books? Now, with the loss, I'm going to debit P and L 50. I credit hedged item. I credit hedged item with 50. I credit hedged item with 50. That is on my hedged item. I have a loss, I debit P and L. When I come to my hedging instrument, for me to account for the profit on the hedging instrument, it will depend. We can write this for the gain on hedging instrument. The gain on hedging instrument, it will depend if it is fair value hedge or cash flow hedge. It will depend if is it fair value hedge or cash flow hedge. Now listen, if fair value hedge, then debit hedging instrument, with 70, total of the gain. You credit P and L with 70. You credit P and L with 70. You credit P and L with 70 if it is fair value hedge. If it is cash flow hedge, then divide the gain into 2. If cash flow hedge, then divide the gain into 2, i.e. effective portion and ineffective portion. Effective portion and ineffective portion. Effective portion and ineffective portion. You are going to divide it into 2. The effective portion and ineffective portion. Now, let me show you. Therefore, if it is cash flow hedge, I'm going to debit hedging instrument with total of 70. Then I'm going to credit cash flow reserve. Or we call it OCI with 50. Where am I getting 50? Remember, the loss on my hedging instrument was 50. Therefore, that one we are going to call it effective portion. Effective portion. Effective portion, that is the loss, that total loss that I made on my hedged item. when we are offsetting it, we call it this is the effective portion. Therefore, remember, the profit was more than the loss. As you can see, the profit was more than the loss. Therefore, out of this profit, I'm going to divide it into the effective portion and the ineffective portion. Therefore, the effective portion is the total loss that I'm offsetting. Then the balance, I credit P and L with the balance, which is 20. This 20, we are going to call it the ineffective portion, the ineffective portion. Then, if it is a cash flow hedge, we are going to introduce what we call cash flow reserve, which will take the effective portion. Then the P and L will take the effective portion. But if it is fair value hedge, total amount goes to P and L. If it is fair value hedge, total amount goes to P and L. That is how you account for. That is how you account for this. That is how you account for this. That is how you account for this. Any question there? Any question there? If there is no question, then we look at one question that is, which question? September 2021. We look at the question of September 2021. September 2021, I believe you are going to September 2021. September 2021. Question number 4. Question number 4. September 2021, 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 question number 4, it says, number 4.1, it says, International Financial Reporting, that's IFRS 9, Financial Instruments, Recognition and Measurement provides guidance relating to hedging and allows hedge accounting where there is a designated hedging relationship between the hedging instrument and the hedged item required. Citing relevant examples, explain two main types of hedge and describe their accounting treatment in the financial statement of an entity. Therefore, when you go to our notes, you will see the examples. For example, the main examiner wanted the fair value hedge and the cash flow hedge. Types of hedge, main is fair value hedge and cash flow hedge. Therefore, when you go to our notes, I believe you will get the examples are there. And the accounting part I have showed you. The accounting part I have showed you. The accounting part is not in the notes, but I have showed you accounting part. For example, if it's fair value hedge, you just debit P and L. We debit hedging instrument. You credit P and L. If it is a cash flow hedge, you are going to create what we call effective portion and the ineffective portion. Therefore, I believe the accounting part you have understood it. Examples, you go to notes, you will get where I mentioned interest rate swaps. Number 2, Bahat Limited entered into a hedge in order to protect its future cash flows relating to recognized financial asset held at amortized cost. The cash flow hedge was formally documented on 1st July 2020 and was considered to be highly effective. At the inception of the hedge, the value of the hedging instrument was nil, but by the year end that is June 2021, a gain of 22,750,000 had been made when measured in fair value. The corresponding loss in respect to future cash flows, that is hedged item, amounted to 22 million fair value terms. Required, show the relevant journal entry to account for the above transaction for the year ended that June 2021, and explain whether the cash flow hedge is effective or not. 6 marks. Therefore, what the examiner wanted here, he wants us to show if it is effective or not, but first we account. Therefore, here, the loss on hedged item equals to 22. That is the loss. And the gain on hedging instrument is 22,750. 22,750 is the gain. Therefore, how do I account for the loss? The loss here, you are going to debit P and L with 22. You credit hedged item with 22. But when I come to the gain on hedging instrument, this I would assess myself and ask myself a question. Is it a cash flow hedge or a fair value hedge? I want to hear from you. If you read this question, is it a cash flow hedge or a fair value hedge? For example, I had shown you the example, but I have not done this question. Then you are going to look for it. How will you conclude? Is it a fair value hedge or a cash flow hedge? Waziri, is it a cash flow hedge or a fair value hedge? Quickly, is it a fair value hedge or a cash flow hedge? Anyone? Not quitting, you say cash flow. Yes, thank you. You are correct. You are correct because the examiner is saying that Bahati Limited entered into a hedge in order to protect its future cash flows. If you are protecting your future cash flows, that's a cash flow what? Hedge. If you are protecting your future cash flow, that is a cash flow hedge. Therefore, this one is a cash flow hedge. Cash flow hedge. Therefore, what do I do? I'm going to debit hedging instrument with 22,750 total of the profit. Then I'm going to credit my cash flow reserve or OCI with 22. The total loss I met, the total loss is 22 million. Then I also credit P and L. I credit P and L with 750. This is what we call effective portion. This is, we call it ineffective portion. The ineffective portion. Therefore, that is what the examiner wanted, and this, for me, I can conclude that it's effective because it has hedged total of the loss, total loss. Therefore, I can conclude that it is effective. Therefore, let's have a break of 5 minutes. When we come back, we go to impairment of financial asset, impairment of financial asset. We go to impairment of financial asset, impairment of financial asset. When we come back, we go to, or before we go to impairment, we can do what we call embedded derivatives. We do what we call embedded derivatives. Before we go to impairment, we are going to do what we call embedded derivatives. Embedded derivatives. Let me write here our next agenda. Let me write it here. Our next agenda is embedded derivatives. Before we go to environment, we are going to do what we call embedded derivatives. Embedded derivatives. When you check in our notes already, we have those embedded derivatives. A break of 5 minutes, 5 minutes head break, so that you also take some embedded derivatives. Now, when we talk of embedded derivative, and this is a financial instrument that has two components inside. A financial instrument that has what, good friends? Two components inside. I.e., it has what we call the host contract. It has what we call the host contract and a derivative inside. A derivative inside. Therefore, on outlook, on face value, you are seeing it as one instrument. But inside it, there is something embedded inside. Example of this embedded derivative is like when we have a convertible bond. If you have what we call a convertible bond. Remember yesterday, we were just looking at bonds. But now I have changed the view to say a convertible bond. Now, if I have a convertible bond, what does it mean? A convertible bond means that in future, I will convert it into shares. I will convert into shares. I will convert this instrument into shares. Therefore, today it's a liability. Today it's a liability, which is a bond, but in future it will be shares. In future it will be shares. Therefore, from the beginning of this instrument, according to IFRS 9, it has two instruments. It has the host contract, which is a liability. A bond is a liability, I believe you understand. Then there is a derivative embedded inside, which is equity component. Which is equity component. Therefore, out of this, on the first one, when we hear a convertible bond, you just see that it's a bond. But when we go inside it, there is something embedded in it. We call it a derivative, which is the equity component. Now, according to IFRS 9 or IAS 32, you are required to separate these two items. If it's a convertible bond, you are required to separate this host contract, which is a liability, with the derivative, so that, because, why are we separating? Because the way I account for the liability is not the way I account for the equity. For the liability, I can amortize. This one I can amortize. I can amortize that liability. But when I come to equity, I can never amortize equity. You can never amortize equity. Equity is held at fair value. Therefore, you can never amortize what? Equity. Therefore, because of that reason of separate accounting, you are required to separate the two. Now, how do you separate these two items? How to separate compound instrument. How to separate compound instrument. How do I separate? Number 1, determine you determine the fair value of the instrument. Number two, determine the present value of the instrument. The present value of the instrument. Then find the difference. Find the difference. Therefore, it means that the difference between the fair value and the present value of this instrument is what we are going to call the equity component that is embedded in the instrument. The equity component that is embedded in this instrument. The equity component that is embedded in this instrument. The equity component that is embedded in this instrument. That is what we are saying. Therefore, when you hear of a convertible bond under IFRS 9, just know that this is a compound financial instrument and I need to separate. I need to separate first before I account. Now, example, let's look at one example. Let's look at one example. Example, we are going to May 2018. May 2018, question number 5. Example, we are going to May 2018, question number 5. May 2018, question number 5. May 2018, question number 5, kindly, quickly. May 2018, question number 5. And in that number, question number 5, it's a published question. That is a published question. We go to note number 3. Note number 3. Note 3. Note 3, May 2018, question number 5. It's a published question, but the examiner embedded it inside there. Examiner put that component inside there. Therefore, we want to see how you account for that instrument. Examiner embedded it inside there, note number 3 of May 2018, question number 5, note number 3, note number 3. It says like this: on 1st April 2017, G Limited issued shillings 3 million 6% convertible bond at par. Each bond could be redeemed for cash or converted into 3 ordinary shares on that 1st March 2020. The interest due on the bonds was paid on 1st April 2018, and the equivalent interest, effective interest rate on similar bonds without the conversion rights is 9% per annum. The only accounting entries which had been made as at that 1st March 2018 were to recognize the 3 million cash proceeds as non-current liability. Therefore, because it was just a note, examiner did not put the requirement. But our requirement is show how G Limited will account for the above. The requirement is show how G Limited will account for the above. Show how G Limited will account for the above. Therefore, we want to see how to account for the above. It says like this: G Limited, on 1st April 2017, G Limited issued shillings 3 million 6% convertible bonds at par. Therefore, if you just hear a convertible bond, then that is a compound financial instrument. Compound financial instrument. That is a compound financial instrument. That is a compound financial instrument. Now, let's do the analysis of this question. Analysis. Analysis is that nominal value of the bond is 3 million. Because we issued, G Limited issued, therefore it becomes the liability. Now, what is the coupon payment? Coupon payment is how many years? Coupon payment is 6%. Then we have effective interest. I believe I explained this yesterday here then, effective interest, which is effective interest is 9%. That is the finance cost. Maturity period. Maturity period is 3 years. That is from 1st April 2017 to that 1st March 2020. That is 3 years. 3 years. 3 years. Anything else? There is nothing in this question again. Therefore, this is a convertible bond. Therefore, I need to get the fair value. The fair value equals to, how do I get the fair value? Somebody shared the question, that is May 2018, question number 5, note number 3. We are just doing a note in that question. It's a very good one. Fair value, you take the nominal value, which is 3 million. You come to less discount. In this question, there is no discount. You come to less. You come to less issue cost. In this question, there is no issue cost. Therefore, the fair value is 3 million. Therefore, already I have the fair value. The fair value is 3 million. The fair value of this instrument is 3 million. Then I come to the present value. Present value, you discount cash flows. You are going to discount cash flows. You are going to discount cash flows. You are going to discount cash flows. Where do I get cash flows? Cash flows equals to, where do I get cash flows? You get the coupon payment, coupon rate, times nominal value. Nominal value, which equals to 3 million times 6%, 180. Therefore, my cash flow that I'm going to discount is 180. Cash flow that I'm going to discount is 180. Then let me discount and get the present value. Let me discount and get the present value. I'm going to discount for how many years? 3 years. Therefore, I will say year cash flow discount factor, then present value. Present value. This is a lump sum. Therefore, I'm going to use the formula 1 plus R raised to negative. And that is the formula to determine the discount factor. 1 plus R raised to n. Therefore, year 1, my cash flow is 180. That is my cash flow. Discount factor, I believe you know how to determine the discount factor. It is 1.09. We are using the effective. Here we use the effective, which is 9%. Effective, which is 9%. You use the effective. When you are determining the discount factor, use the effective. 1.09 raised to negative 1. I'm getting 0.9174. That is my discount factor. Now I take 180 times 0.9174. 165. I'm rounding off. Maybe we'll get figures some points. I'm rounding off. I'm rounding off. Then in year 2, still cash flow is 180. 180 discount factor is 1.09 raised to -2. 0.8417. I'm rounding off 17. Therefore, it will be 180 times 0.8417. 152. I'm rounding off 152. 152. Then in the year 3, that is our redemption year. Therefore, in our redemption year, I have the nominal value of 3 million to pay plus 180 the cash outflow. Therefore, I need to pay 131.80. In year 3, that is our redemption year. In year 3 here, I have 31.80. 31.80. Therefore, it will be 1.0. 0.22 there. Therefore, I will take that 180 times 2456. Therefore, I add to get my net present value. I add, it will be 165 plus 152 plus 2456. 2773. That is the present value which makes the liability in this bond. That is the present value which makes up the liability in this bond. Present value which will make up the liability. This will make up the liability. That will make up the liability. Present value will make up the liability. Therefore, my equity component, let me shift here, I say, my equity component equals to, you take the fair value minus present value. We said to determine the difference. Equity component equals to fair value minus the present value. Equity component equals to, you take the fair value. What was my fair value? 3 million. What is my present value? 2773. Therefore, what is the difference? $227. Therefore, that is the equity component in that. We have separated. Now, that equity component, you report it in the balance sheet as other components of equity. You report it in the balance sheet as other components of equity. But this liability, we are going to amortize it to realize the finance cost and the liability at the end of each year. We amortize it. We are going to amortize that liability. We are going to amortize. Now, can you allow me to amortize? Yes, I can amortize this liability, because a liability bond we amortize, but equity we hold it at fair value. It only changes in fair value. Therefore, let me try to amortize. I believe this one you are through. Let me prepare the amortization schedule and see how we are going to report on this. Let me prepare the amortization schedule. I will say here, principal balance, interest, then installment, then balance, current down. We are only doing for 1 year, 2 years. Let's extend to 3 years, or we can do 1 year. We can only do for 1 year. You can only do for 1 year. It's just an illustration. Although examiner wanted you to do this, I'm showing you. Therefore, in my year 1, you are amortizing the liability, but with equity, you hold it at fair value. You hold it at fair value. My principal balance is the liability, which is 27.73. My interest here is 9%. Coupon payment is 6%, but on the nominal value, which is 180. Coupon payment is always based on the nominal, but I explained that yesterday. I insisted that on that yesterday. That the installment or the coupon payment, we always base it on the nominal value, but the interest, that's the finance cost, we base on the balance brought forward. Therefore, here, what is my interest? My interest will be 2773 times 0.09. I'm rounding off to 250. I'm rounding off to 250, although it's 249.57. Thank you very much. You say 450. I'm getting 250. 9% of that. Thank you very much. Thank you very much. Now, my balance at the end will be 2773 plus 250 minus 180. I'm getting 28.3. Then in year 2, I will bring 28.3 there. It continues, but I only want year 1 because examiner wanted year 1. Examiner wanted year 1. Therefore, that is the only indentation that I'm doing. Examiner wanted year 1. So examiner, when he wants year 1, don't do waste time doing other things. Just concentrate on year 1. Therefore, how do I report? Profit and loss extract. In my profit and loss, I'm going to recognize that is year 2018. Finance cost. It will be 250. That's what I was to take to that published financial statement. Remember, that was a published financial statement, where I was to take that 250 to report as my finance cost. Then I go to balance sheet or statement of financial position, extract. Balance sheet or statement of financial position. Statement of financial position. I am still in year 2018, end of 31st March 2018. I will go to financed by section, financed by, where we have equity, ordinary share, blah, blah. Therefore, I will report other components under ordinary share. I will report other components of equity, other components of equity, which was 227. Other components of equity, that's a reserve, other components of equity. Then I come to non-current liability. Under non-current liability, I have 6% bond, which I'm going to report this balance at the end, 28.43. Therefore, in that note, you are to get 7 marks in that note, and that is how you are to get it. That is how you are to get it. Here, 250. In the P&L, you report. If you don't report that, you lose that marks. Then in the balance sheet, under equity, ordinary share capital, share premium, with valuation, we have other components of equity. We separated that 227. It is here. 227 is here. Don't ask Marine. Where are you getting 227? 227 is the difference between the fair value and the present value, which we recognize as equity component. Therefore, that is a compound financial instrument. Whenever examiner brings forward a question and you see a question, examiner is saying a convertible bond, according to IFRS 9, don't ask yourself other questions. Just know that this is an instrument that I need to separate the fair value and separate the equity component from the liability, because we cannot account them the same way. We cannot account for them the same way. Remember, the equity component, you hold it at fair value. The liability you amortize. Once, I said yesterday, once you have the coupon payment, once examiner has put the coupon payment, then you just know that this one I will amortize. Once you have the coupon payment, just know there's no any other way. Once you have the effective interest and the coupon payment, just know that this one will be amortized to get the finance cost and the liability at the same time. Or if it is an asset, remember I said it can be an asset or liability. If it's an asset, you get the finance income, interest income, and then this one is the net asset, net investment, or the net assets. Now I see we have less than 15 minutes. I cannot do the topic on impairment of financial assets. I cannot do it because it means I will rush and will not understand. And that is just one note in a question with 8 notes. Yes, it was just a note like that, and this is what you are required to do. Therefore, you can see what you are required to do. That's why I insist that you need to revise a lot so that you gain a lot of speed. When you get such like these things, your speed is too high. Your speed is too high. Therefore, remember, I already told you the concept of the learning curve. Learning curve. You will do it in MA, management accounting, the learning curve. The more you do something, the more you gain experience, the more you gain efficiency, the more you gain effectiveness, the more you increase your speed. Therefore, you need to practice these questions like what we are doing. Make sure you practice them. I know there will be maybe a hiccup here and there, but when you are doing them frequently, you will increase on efficiency. For example, the topic on financial instruments, as we are doing it, when you revise it alone, you do several questions alone, you will find that your speed on doing this topic is increasing. When you go to the topic of share-based, do a lot of questions so that in an exam, if it is there, you take like 3-4 minutes, you are done with the share-based question because you have revised it very frequently. But if you just wait for the night, tomorrow is an exam, you read 2 gram, then you go to an exam, you will be taking 30 minutes on one note. Like this one, you take 30 minutes. That's one note. You take 30 minutes because you do not revise very well. Therefore, you are required to revise and analyze these things, what we are doing. Therefore, because of time, we cannot do another subtopic impairment. It means that we shall finish it on Monday as we go to another topic in this. As we go to another topic. Thank you for your time. Bye-bye. Thank you. We meet on Monday.